Right, everyone. So welcome back to the India Market Review. This is for the week ending Friday, 16th September 2016. It's been a pretty, I would say, exciting week, I think, for a lot of people, not just in India, but across the world. We've had a big gap down on Monday, and then Tuesday was holiday here on account of Bakrid, and today morning we had a massive almost 100-point rally on the Nifty, and people are wondering what's going on, and then it pulled off towards the end of the day. In the US, we've been having actually seen some pretty big moves intraday, as you will see soon. And I'm sure a lot of people are, wondering the first part of this webinar, which we're going to devote to the question, is the bearish view stronger? Or given the sort of up move that we had today and maybe yesterday, are we going to review that and are we in a bullish mode? Right. So essentially, in this free part of the IMR, part one, we are going to do our global indices, and then we're also going to look at India sector indices and see, what's going to go on there. And then in the part two, which is for the IMR subscribers and the mentorship group in Bangalore Investors Club, we'll do a review of the Nifty 50 stocks. Last week we did a review of the Nifty Next 50 stocks, the mid-cap stocks. Now we're going to do the 50 and get back to the mainstream stocks. One, of course, important reason for that is because all these stocks are also in the derivatives FNO side. All right, so without further ado, let's get into asking this question about, is the bearish view on Indian market stronger? Technically, what do we have to say? And yeah, just want to make an announcement that sometime in the next 1 to 2 weeks max, we will be doing a very, very comprehensive, very in-depth, detailed review from a fundamental perspective of all the top indices in India, the Nifty, of course, and then all the sector indices, and then we're going to basically look at where is value, excuse me, if there is value, and at what level are the various, not only the mainstream indices, but also the sector indices. When we did this about 4 or 5 months back, we found some extremely attractive picks on which, if you had followed, you would have made minimum 50, maybe even 100% returns on things like reality networks and capital goods, I think. Right. And things have changed a lot in the last 4 to 6 months in India, of course, and the valuations are quite dramatically different now. So we're going to do that. So just letting you know, in case you're interested, do get in touch, keep in touch, be on our mailing list, be on our SMS list, and you'll get an update about what we're up to. All right, so let's jump in. So we want to first look at how our global indices are panning out. So let me start with the US of A. So this is the S&P 500 list index, and on 9th of this month, which was I think Friday, right? Yeah, right, last Friday, we had this big massive red candle down here, and on the Monday next we had this big massive up move candle right there. Right? Now this is definitely a lot of volatility which has gone around in the US markets. These are like huge moves compared to what's happened in the last about 4 to 6 weeks, as you can see just from the size of the candle. And it's come after 4 to 6 weeks of consolidation, and those of us who've been regular on the session know that we've kept talking about how this is probably maybe a distribution phase that you might be looking at, and if you basically look at it from a pretty long-term perspective of let's say you can go to weekly, what you're going to very quickly see is the rounding top type pattern which we have, And whatever move we've had this week, including a bounce today, if any, is just, in my opinion, bounce exactly. And it's at this point, I think, very unlikely that S&P 500 is going to go to 2180 at this point, right? More likely that it's going to, maybe consolidate if at the very least, and then once 2120 breaks, we're probably going to see 2080 or even much lower levels of perhaps even 2040. That's on the S&P, and if you look at the Dow Jones, uh, so these have all, of course, been hitting their life highs, and then they have come off their life highs. So essentially, there is life high for yeah, right. So same way Dow Jones has really come off, and right now just sitting at its support level there, okay, which is close to, in a sense, the support zone, if you can prefer to call it that, which is basically just another life high. And I really look at that a lot because tends to give some pretty good supports and resistances. So you can see from the past, if we go back to the weekly chart, you can see that we are in a support zone. So this is potentially a strong support zone, right? And one could argue that it could go up from here, but at least I'm a little circumspect right now. Given the sort of strong red candles that you see, it's really not easy to break that sentiment in the market. So, and in a sense, you've got a double top there, and if I can just put a trend line here. That's what we basically wrote down through. Right. So I am, you know, at least as far as the U.S. markets are concerned, I think they've topped out for now, even if one is not very bearish. The reason being they are at these important support levels. I think the upside is pretty limited at this point. Right. There has been talk about the Fed rate hike may not happen, may happen, in spite of all of that. We just move over to Europe and look at the biggest, or the most important index there, and you see this big gap down which happened. And what you can see basically in the DAX is that a nice broken that support level right there, which I put, and it's now, that support has now effectively become a resistance. Again, it's in a support zone, and I would think 10,000 psychological mark down below is something that it is most likely, in my opinion, to go down to. But I think we just have to wait and watch. And we do have a sort of double top at this point. We've got a shooting star there and a bearish engulfing here. There's sort of double bottom, tweezer stop pattern there, and it has definitely broken down. This sort of a gap down is pretty indicative and a strong signal in candlesticks. Right? So 10,000 down on the DAX, I think, is a pretty likely thing. And then we look at FTSE. For some reason, the FTSE data not getting updated fully. It's today's data not that, but essentially more or less the same thing, breaking supports and then probably going down to 6,400. Right? There is some talk again about the second referendum about the Brexit. It seems to be taking on quite a bit of traction. If you've been watching BBC, then the ex-deputy prime minister, who is guy's name, Clegg or something, he's actually been sort of supportive of it in the parliament, in the UK parliament, of course, and who knows? So there could be a pretty positive surprise at that end, but I think it's a long way to go. If you look at CAC and So that's also very much down. Gap down, pretty good multiple top. So CAC actually never broke that support. DAX did, FTSE did, but CAC never did. Right? It just not follow through, and then from 4600 we are now back to almost 4300, and most probably, in my opinion, headed lower to 4100. So this is my view on the CAC, and while we are at it, let's also have a look at Nikkei. And on the Nikkei, we've also broken supports there, right? So we've broken support on the Nikkei, and again, gap down and going down on pretty good red candles. Something wrong with the volume chart. My apologies, and you have to know that. And it's going to 1620 and probably go to 1580, 1620 breaks. At this point, it doesn't look like any of the large global indices of importance are going to hold the supports, in my opinion, and I think there is more downside on that front. And therefore, now coming to India, I think makes my analysis pretty straightforward. If you want to just keep it sort of simple, and that's what I'll do here. Okay. So this is today's data without any. Okay. All right. So a little bit of clutter maybe for some people. So let me just orient this quickly. So this is Monday's gap down. That was a big, massive, bearish gap that we found. And then today, for all practical reasons, in a sense, I would say that that gap was closed with this massive up move. So this low here, right, was 88.58.7, and today's high was 88.47. So about 10 points gap is still there. I think really immaterial, but the market did try to rally up and then got beaten down. What's very interesting also is the very high volume today. So it went up for a lot of churning in the market, and then we've just seen it settle down after that. It's broken all the short-term moving averages. I think the closest support where it could maybe for at least some stop the fall is 8600 on the Nifty. I don't think anything else is going to help it. And if I take this trend line that we drew, which was a neckline of a head and shoulder top, which didn't actually play out, and you can see that that could also, in a sense, be a double support, but I'm a little skeptical at this point. Look at it on a weekly chart. You can see what I sort of reiterated last time. We have a shooting star there. This was first quarter of 2015, and we have another shooting star here just last week, and today this was a very weak candle for this week, right? So the one there. We've got for all practical purposes, a sort of double top situation on a weekly chart, and I would say the volumes are definitely now petering out. Okay, not enough to say that we are in a firm downtrend, but definitely the volumes are petering out on the upside. No doubts about that. If we go back to daily, so today we had a shooting star of sorts. Again, big volumes to north, so 8600 I think, and then if 8600 breaks, then 8400, and then we'll see. Lower, I think, is a very, very distinct possibility. So this is, I think, where we are sitting right now. Very critical juncture. Any long position should actually happen only if the market is somehow able to break 9,000 in some meaningful manner with a lot of conviction and strength and all, which honestly right now, given the global situation and now superimposing that on the Indian situation, I really don't see that happening. So all market action, global and local, seems to indicate that we are headed for lower levels till 8600. Right? That's my opinion. Well, it's basically, I guess, a market to short, depending on how you do it. It's really up to you whether you use futures or options and what sort of risk appetite and risk management you have is something we'll discuss in more in part 2 of the webinar, but mostly the view is now down. So which brings us to now the sector indices. So let's get into that. The Nifty Junior, so this is something that I've been talking about for at length, which was the ascending rising wedge, sorry, right? And the rising wedge finally did break down, and right now I might add that this is now looking like a flag in a sense, set to fall further, in my opinion. So let's put the boundaries for that. And that is what I will track. So that's one level. And that's another level. So we've got a gap down. The gap has really not closed, and I believe that it's just a matter of time that we will probably see. So this is like a downtrend flag. So we've got a fall from around 23,600 to 22,700. So basically about a 1,000-point fall. You can expect another 1,000-point fall. So 22.8, so 21.8, so take it to about yeah. So first stop at around 22,200, and then could easily fall to 21,800 in my opinion. Sad that there's not too much liquidity in this. But I'd love to have that opportunity. So also one thing is that it's run away quite a lot from its MACD, moving averages, etc. So there needs to be that correction too, and we've also been speaking quite consistently for the last many weeks about this bearish divergence, which I was looking, or we did mention a possible divergence trap, and I think that's really what's happened now and come true. Right. So the divergence trap we've corrected, and it looks like the Nifty Junior is also firmly on its way down. This brings us to some of our sector indices, right? So let's start with the one with the biggest weightage, the banks. So looking at the bank Nifty, well, more or less copycat patterns of the Nifty. You can see, except I would say that even more bearish here. So this was a sort of double channel. You can describe it by various books, and I'm sure different authors will have different things to say about it. You could maybe even put an Andrews Pitchfork study there, but whatever it is, and yeah, you can see in the case of Bank Nifty, a sort of double triple top here again. 2015 clearly went there. See, one of the reasons I just love TA is this sort of accuracy that happens. Looking at the bodies here, looking at the high here, and we come just exactly there, right? Give or take a few 5-10 points, and then we start to cool off, and we got this gap down, gap closed, and once this level, which is the middle sort of channel, breaks, and it's also the middle Bollinger Band right there in that, sorry, yes, in this green line. Right. Once that breaks, then I think 19,100 on the bank is more or less a given. So that's also more and more bearish. We've got a doji today. Right. weekly chart. Looking at the PSU Bank Index to see if they are doing better or different. Well, we did mention about the support level, about which was potentially looking good, and essentially they've come back down to that. So you basically want to track that, I think, carefully. And the PSU Bank Index, in a sense, in terms of overall technical setup, one had to be long. Maybe that is better than looking at private sector banks. So perhaps continuing with the theme, limited downside, but still would not be ready to buy this right now. As the overall market weakens, this would probably correct to perhaps 2830, 2850, 2900 levels. Unfortunately, not a traded index. This would also have been nice to trade. So whether it's so the private banks are probably weaker than the public sector banks, right? Okay, we'll bring in the CNX PSU banks and the CNX private sector banks into our study in the due course of time as we get more history on them available, back history. Okay, coming to some of the sectors that have been outstandingly well in the last many weeks. One of them has been autos, creating life high after life high, not only on individual stocks but also on the index itself. It was clearly an outperformer sector, but now it's really gone back in line with the overall market. So here is the flag again, right? We have that. That's your downtrend flag, right? I believe will fall from 23,200 to 21,000. Just to keep it simple, 300 to another 1,000 points, so 22.4 minus 1, 21.4, right? So somewhere, well, which is nicely coinciding with somewhere in the region of where the 50-day exponential moving average is. And if I may add, if I extend this right, which was again a head and shoulder which did not break down, in the Nifty it did, and then bounced back. In the autos it did not, in a sense. Not actually head and shoulder, more like a descending triangle. There you have it. Which actually broke out, and then we're coming back probably to these levels in my opinion. So autos also weak. Consumer durables, okay. So these have clearly made a new life high and have again corrected with the overall market. So they've come back to their old life high essentially. And if they break that, then we should go lower. However, little circumspect about it, keeping other things in mind with festive season around the corner, we may be a little wary of getting out of this too soon, in my opinion. Right. What happened to all of this? Right. So, so not too much in a hurry to get out of consumer durables, but weakness is there. I wouldn't be long on it aggressively either. Capital goods, so that's like really been stuck in that range that we have been speaking about, haven't yet broken it. But you know, so the thing about capital goods is it's really got some good supports on its way down, and that's what we basically want to be watching out for, right? So consumer durables, just give me 30 seconds. All right, so Some sectors very clear views, others a little circumspect. So need to be very clear about that. So capital goods definitely showing weakness, no doubt about it, except that they have plenty of good support, just a few, 50, 100 points down. And well, a lot of talk about infrastructure growth and this push and that reform and all. Looks like the market, I'm not sure convinced about it. And there is this big window in this index which hasn't been closed. So for that to close, you need the market to fall about 13,000 to 13,200 levels. We're talking about a 10% correction from where the capital goods space is right now. Having said that, all these long-term moving averages there that would provide some support. So it's iffy there. FMCG, wow. Right, so FMCG comes to its support, as you can see, and has actually gone up, right? Very close to 50-day moving average, very close to a support zone of July, August, September, so 2.5 months, and then it just managed to go back up. And FMCG has actually been making, new life highs for about a few weeks now, and looks like it hasn't totally given up on the up move. There is definitely some amount of weakness, I think, in the entire move now. You're seeing even in the weekly chart, the move getting tired, in my opinion, clearly getting tired. And I don't think there's too much headroom right now for the FMCG either to go up. It's next after building a band, it's from a doji, weekly doji last week, and then sort of small hanging man type candle this week. So, well, okay, actually, you may want to short it if it goes to around 9,000 levels, right? That's I think what I want to be looking at as far as FMCG is concerned. Healthcare really also done some mild green ticks today and plenty of support. So I think that's another thing that you don't want to actually healthcare. If we look at CNX Pharma, more or less the copycat picture of the healthcare index. This could be, FMCG and healthcare on account of being defensive sectors could be the places where the money could rotate into as it gets out of those other sectors. Little too premature to say get in, but at the very least I'd say do not short these at this point. Okay, pharma and FMCG. Coming to IT, well, the down move continues as we predicted, and it's in a sense getting sharper. So it's yeah. So at around 10,200, 10,250, very important critical support zone for the entire 2015, 2016, and like I said, I'm expecting this to actually break, and if that happens, then we've got IT coming down much more. Is this a consolidation or move downtrend? I mean, see it in P chart, where you can see that over almost 2 years, we've got a sort of distribution type pattern there, I think. This is in a sense where we could perhaps draw some support line, neckline, call it what you want, and I would say that it has broken or is in the process of breaking. All depends on the point of view. And in a sense, this is a massive head and shoulder rounding pattern of 2 years. And this is how long distribution can actually take sometimes, right? 1 to 2 years. And in spite of Trump's claims that he's going to make the US economy grow at 3.5%, and the recent, I think, H1B new law was taken off the US Senate, Congress for voting. So that's a temporary relief in my opinion. But over a 2 year period, I think it's really a good cutting uh, pattern. Okay. Uh, okay. Audio. Yeah. So as I was saying, the BSEIP being a sort of pretty big earning pattern. Let's see where this goes. Okay, let's come to the daily chart here, and so watch for a break of 10,000 on the VSC IT, and I think a breakdown of that is clearly going to take this down much more by another 10-15% is easily possible, I think, on the BSC IT side. So that's something to definitely keep in mind. Coming to metals, so finally, this is something we were a little hesitant about, but when we kept saying be cautious, we talked about this bearish divergence on the metal index, and quite honestly, I didn't expect this sort of a fall on Monday. It just cracked, and things like Hindalco and all that down 8, 9, 10%, and continue to go down today, and they've broken the 50-day moving average, and I think it's just a matter of time that they go down another at least 500 to 1,000 points on the metal index. It could bounce up a little bit in my right, but every bounce should be used to get out of metals further. And well, let's see. Really, no meaningful correction has happened for almost about 4 to 5 months now. So this could be a pretty sharp correction, both in terms of price, especially, if not in terms of time. But at this point, it's definitely looking quite bad, in the sense that beautiful opportunity for shorters. This is a weekly chart right now, and you can see that you have the first substantial weekly red candle after 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 3 months of the market just going up. Uh, right. Okay. So metal definitely now weak. There is no doubt about it. The other one we had some reluctance on was reality. Well, reality broke down on Monday, and then you can see how it is doing this beautiful dance with its resistance, both the yellow line and the 50-day moving average. Long shadows this way, that way, and mostly this is of course DLF. But I would say reality is to be shorted with a stop loss at around 1570 on top, and then it's easily going down to 1500 at the lower level. So this is where reality is. So quite honestly, not a single index which I would think is strong right now. Everything is short, including now metals, reality, and yeah, that's it, right? So this is a pretty weak market now, right? Zilch. So there's really no long opportunities in the market, in my opinion. So if you are a spot investor, uh, definitely should be, from an overall perspective, exiting your long positions if you haven't already, because quite clearly I think the market is headed for lower levels. You will get bounces, right? You will get bounces, you will get all sorts of interim news and um, um, reasons to hope, but I think the charts are pretty clear today. Right? It's not often that you come to sometimes such a clear-cut view on the market. We've been diffident and hesitant about it for the last few weeks, as any regular person on the IMR knows, but I think now it is pretty clear-cut as to uh, where we are headed right now. Right? Okay, so that's it. So that brings us to the end of part one of the IMR, and I'm basically going to close this down here. So if I think the question is pretty um, emphatically answered. Is the bear issue stronger? The answer is definitely yes. Right, there is no doubt about it. And well, of course, there's plenty of opportunity to trade on the index itself. I'm quite sure you're going to find some really good ones in the nifty individual stocks, and that's what we're going to do in part two. All right, so we're closing the webinar here for part one. There's a few who are online right now. Just hang on. We'll get a new link for part two, and there's a few who would like to watch part two later. You can complete the formalities that are described on this link and get in touch, and we'll send you the recording for part two. Right. Thank you, and see you in a couple of minutes.